do, does it?
Well, I think there was one thing that was really important to note over that time period was most of our risk appetite indicators went into panic mode. So we were kind of hovering around there when the market made its initial decline in the month of August, when you went down, pretty much 11% over 6 straight days. But it reached it again at the end of September. And when you reach panic on most risk indicators, it's a very good sign that the market's making some type of a capitulation.
So on a technical basis, but the panic was engendered by fears of a slowdown, and then it was cured by a terrible jobs number, which makes no sense.
No, but here's the thing. But markets have not been kind of making much headway throughout the entire year.
True.
So there has been pretty much no investor kind of really ebullience through most of this market cycle that we've been in, and especially this year.
Because if you look at mutual fund and ETF flows altogether, there's actually been net redemptions from domestic equities. So one of the things that you normally see in a bull market top is that you have big retail or individual investor participation. You haven't had that this time. Having said
the household names, these are huge performers off the low of August 24th, meaning they're not only up a lot, they're up relative to the market. The market's only up 10%. And all these names, of course, everybody knows. Here's again the first panel. Here's the second. Market's up 10% off its low, massive outperformance. But the biggest one of all, Intel, is up the most. And guess who's most correlated with that? Microsoft. So let's look at some charts and try to put it together. Here is a 1.5-year picture. The correlation's quite high. In fact, Microsoft higher with Intel than any other stock on that list. And it looks, to my eye, that Microsoft is setting up well for a breakout. So here's our plunge. And we've recovered. And we have this formation that's starting, this tight trading. And the presumption is that you're going to get something of a breakout out of this setup. So we're back to the level or the scene of the crime. Market has not done that. The setup is perfect, and I think you get this breakout.
Markets out there.
I think what the markets are looking for is basically a stabilization. And I think increasingly we're seeing some of the numbers starting to turn a little bit. For example, I think on Wednesday when we had the trade numbers coming out from China, you could see that the export numbers were not as bad as what the market was actually expecting. It was down minus 1.1%, but still it was clearly much better than expected. If you look into the details there, we do expect fixed asset investments to actually drop. Given the fact that property investments and all that, we're still trying to find a bottom where that is concerned. Our view is that it has actually bottomed out, but we're not likely to see new investments coming into the sector itself. I mean, it may not be necessarily a bad thing because fixed asset investment as a percentage of the GDP is still about 50%. If China was to be successful in switching from an investments-oriented GDP into consumption-oriented space, that percentage needs to drop. And I think that might actually drop because in the imports of the commodities that we're seeing right now, the kind of imports that we're seeing in terms of iron ore, coal, steel, that's actually coming off. And that's usually the inputs used for fixed asset investments.
Okay, stay.